Think your mutual fund is truly diversified. It may look like it, but many funds are secretly sabotaging your returns. We'll expose the dangers of false diversification. Learn how to ensure real diversification and protect your financial future. So, you've got a mutual fund. Great, but is it really doing its job of diversification? Many people assume that just because they're in a fund, they're automatically protected. Unfortunately, that's not always the case. Think of a mutual fund as a basket. Inside this basket are different investments, like pieces of a puzzle. These pieces can be stocks, shares of companies, bonds, loans to governments or companies, or even other things. The idea behind a mutual fund is to give you access to a bunch of different investments all at once, making it easier than buying them all separately. Diversification is spreading your money around, so you don't have all your eggs in one basket. If one investment does poorly, hopefully the others will do well enough to balance it out. This helps to reduce your overall risk. This is the main reason people buy mutual funds. But here's the catch. Some mutual funds aren't as diversified as they seem. This is what we call false diversification. Imagine that basket of investments only contains slightly different types of the same thing. It might look diverse, but if that one thing goes bad, your whole basket suffers. For example, you might have two different funds that both invest heavily in large technology companies. Or maybe you have several funds from the same fund family that end up holding very similar assets. This is surprisingly common. It's like having a basket full of slightly different kinds of apples. It's still just apples. If there's a problem with the apple crop, you're in trouble. So, how do you make sure you have real diversification? First, think about asset allocation. This means spreading your investments across different types of assets. Don't just stick to stocks. Consider bonds and even international investments in a global fund or an international fund focused on emerging markets. Remember that different investments come with different levels of risk and potential returns. Generally, higher potential returns mean higher risk. Bonds, for instance, are usually less risky than stocks, but may also offer lower returns. A balanced fund aims to strike a balance between stocks and bonds. Also think about the different sectors of economy your investments are in. There are also different types of mutual funds to consider. Index funds aim to match the performance of a specific market index, like the S&P 500. These are often passively managed, meaning there's no fund manager actively picking investments. Managed funds, on the other hand, have a fund manager who tries to beat the market by selecting specific investments. Before you invest, always read the prospectus. This document tells you everything you need to know about the fund, including its investment strategy, net asset value, NAV, and expense ratio, the fee you pay to own the fund. Remember important concepts like long-term investing and dollar-cost averaging. Also explore using tax-advantaged accounts like a 401k or IRA to help with retirement savings. So how can you avoid false diversification? Research. Look closely at what your funds actually hold. Tools like Morningstar and Lipper can help you analyze your portfolio. Don't be afraid to ask a financial advisor for help. We've covered the basics of diversification in mutual funds, but there's much more to explore. For instance, how do economic indicators and interest rates really impact your mutual fund's performance? And what are the specific tax implications of different investment strategies? These are questions we haven't fully answered here. If you found this video helpful, please like, share, and subscribe for more insightful financial content. We aim to empower you on your financial journey. Thanks for watching.